In this presentation, we will enter a sales receipt, the form indicating the receipt of payment at the same time goods and services are delivered within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in our Get Great Guitars file. Let's first consider what a sales receipt is. We'll do this in a couple different ways. One, if we select this plus item up top and we consider the customers. Last time we have entered an invoice and we discussed the invoice and the received payment. What happens, however, if these two items happen at the same time? That would be the case here when we're having a sales receipt. So you can consider or think about in cases of a sales receipt, rather than us, say, doing work like bookkeeping or something, and then sending an invoice for that work done, waiting to receive payment in the mail, we rather are, we can imagine, sitting by a cash register within our store. So if we had our store where we sell guitars and we have services, we're sitting by our cash register and someone brings the guitar to us and says, we want this guitar and we're going to pay for it now. That's what the sales receipt would do. We would have the payment and the related sale, as well as any reduction in inventory at that time. To consider that too, let's go to the reports. So we're going to go to the reports on the left side to see where we are headed, where we are going. We'll take a look at our standard report, the favorite report, the balance sheet, the financial statement report, or one of the two of them. Changing the dates up top from 01/01/19 to 12/31/19, that's January through December 2019. Run that report. Now, on the balance sheet, what's going to happen is we're going to get payments. So we're going to get paid at this point in time. And that means that the checking account may go up depending on the type of payment. However, if we're getting cash or a check, then we're going to put it into that undeposited funds again. We can imagine our cash register going up as we receive more cash, as we make more sales during the day, which we will then go to the bank at the end of the day and deposit. So the undeposited funds are going to go up, a form of cash is going to go up. The other side we typically think of on the income statement. So in order to do that, let's open two tabs at once. I'm going to go up top, right click on this tab, and we're going to say duplicate this tab. That'll make one called balance sheet. So I'm going to pull this other one to the right. So we have the balance sheet tab, and now we're going to have another tab, and we're going to go to the income statement or profit and loss by going to reports on the left side. We want to scroll down and to our favorite report, our second favorite, or the two favorites, one of the two. I don't want to play favorites between the balance sheet and income statement, but 01/01/19 to 12/31/19. That's going to be the year we are working in, January through December. The other side is going to go in increased sales or revenue. This is our revenue account, our income account, our sales account. Those are going to be the major two accounts that are affected. If we are selling inventory, then if we go back to the balance sheet, we also know that the inventory is going to go down at the point of sale because, of course, we're imagining that guitar being brought up to the counter and then leaving the store, no longer with us, and therefore it needs to go down from a dollar amount perspective from the balance sheet. Also, the other side of that then will be on the profit and loss or income statement. So if we go back to the second tab, our profit and loss or income statement, the cost of goods sold will be going up in the expense direction, bringing net income or gross profit and gross profit down. So the income statement is going to go up by the sales, down by the cost of goods sold. Let's see that process as we enter a sales receipt. To do that, we're going to open up another tab so we can have both of our financial statements, the balance sheet and profit and loss, open as we go. Right-clicking on this tab again and duplicating. Now this one will be called the profit and loss tab. Therefore, I'm going to drag the one to the left to the right. So now we got balance sheet, profit and loss, another tab where we can actually enter the information. And if you don't have multiple tabs or you don't want to do multiple tabs, that's okay. You'll just have to recreate the reports. That's fine too. We will now go up to the plus item, the plus icon, and in the customer section, we're looking for the sales receipt. Remember, what we are imagining is someone brought up the guitar. We're in our store. We're next to the cash register. Someone brought up a guitar, says, I want to buy it. I want to pay for it now. We're basically going to give them a receipt, sales receipt being the form for QuickBooks. Selecting the sales receipt, we see a data input form very similar to the invoice, meaning we're going to have a product, we're going to have the sales tax, we're going to have the total of the product and the sales tax that will then be due, very similar in nature. So when we think of the sales receipt, you probably want to think of something that we might provide to the customer, like a receipt. But typically when we think of the receipt, we may not think of the same data input as what is being put into QuickBooks, as is usually demonstrated when we have a bill or invoice. In other words, when we create the invoice for QuickBooks, we're really talking about the data input screen. That's what the form is. And the data input screen is to help us to record the transaction. The invoice and the sales receipt will be much the same. The only difference is that for the sales receipt, we're going to get payment at this point in time. For the invoice, we have not yet got payment, and therefore accounts receivable will go up. Everything else will be much the same, meaning the sales receipt will record a lot of information just as the invoice did, everything else being much the same other than the accounts receivable and the form of payment that we're going to get for the sales receipt. So let's see an example. We're going to add a new customer, and that's going to be string music. So string music. And actually, I've added string music here, but it should not be in your area. So if you select tab, we're just going to add it. Note that we're going to add it just simply. We're not going to add more detail to it, although if this was in practice, we have a customer, we probably would want as much detail as possible for that customer, but all we need is the name to have the minimum, which is to receive payment. Then we can have the email. If we have the email, we can include the email. We have the billing address. We've got the sales receipt date. We'll increase to the 16th. I'm selecting the plus on the keyboard to go up one day at a time. We don't need any shipping information. We're not going to be adding the shipping information. We'll scroll down to the payment method. The payment method we're going to say is cash. So cash, check, other form of payment. We're going to say that we got paid in cash. We're imagining the guitar being brought up, cash being paid. And then it's going to not go to the checking account because we're not going to deposit it directly right now. If we got cash, we're going to combine it together with any other cash sales. We're imagining ourselves in the store and then go to the bank sometime later. And therefore, if that's the case, want to put it into undeposited funds so we can group those deposits in the format in which they will be deposited. I'm going to select the product or service, which is going to be an Epiphone semi-hollow wood. So we're looking for the Epiphone semi-hollow wood. So Epi Semi, we're going to take that item. We then have the description. I believe it's actually an Epiphone semi-hollow body. So that would be the full description. We got the quantity is 1 that we'll have. We're going to say the rate is given to us at the 400. That being set up once again by the fact that we set up these items, these inventory items already, and therefore the 400 and the amount rate already set. Then we have the tax. We're going to say that we are going to have sales tax. Note how similar this is to the invoice so far. Down below, we see the sales tax calculation. The sales tax is calculated for us by region, but I'm going to change this once again just to have a flat 5%, just to have an example problem. So we're going to select override the sales tax. We're going to put 5% for the example problem, confirm the override, and then we're going to say that it's because of other and confirm the override and close. So now we're saying that it was sold for 400, 5% of that, 400 times 0.05 or 5% is $20, and therefore the total is $420. We're going to say the amount received is the $420. We're imagining that we got paid at this point in time at our store, and therefore the balance due is 0. We then have the message display on invoice, message display on the statement if we so choose, and any attachments that might help with our documentation. The journal entry related to the sales receipt is actually fairly complex as it is with the invoice. The sales receipt means that we're going to get some type of payment, but it depends on the type of payment to be what account we're going to have selected. Meaning, if we got direct payment, if it went directly into our checking account, we may have it go directly into the checking account. If, however, it's cash, we might put it into undeposited funds. Therefore, the payment is received. Undeposited funds goes up, unlike the invoice, which the accounts receivable, the IOU account, would go up. That is the difference. Then the other side would be to sales. So we're going to have cash that was received for the full amount of 420 going into undeposited funds. The other side is sales, but it's only at 400, the actual sales price, the amount we actually earned. The difference between the two in order to be in balance is the $20. That's going to go to the accounts payable, or not accounts payable, but a payable, which would be sales tax payable, who we owe, the state we owe, in our case, New York, whoever is collecting the sales tax. Then we're going to have the other side, which is the inventory going down, the hollow wood body or the hollow body guitar is being sold, and therefore inventory is going to go down by the cost of that hollow body, a number that's not on this statement, but like with the invoice, is known by the system due to the fact that we have set up the product and the correct item related to it, and of course the cost. So we're not going to, of course, show that because we may give this similar to a receipt to the customer. We don't want the cost on it. However, we want the system, QuickBooks, to be able to calculate the cost, record it appropriately in a perpetual system. The other side will be cost of goods sold, the expense related to the inventory going down. Again, same number, the cost, which is not on this form. So then we have the same options of we could email this form, we could print it, the form as a PDF file, or we could print it on a printer, and then we could save and send it if we so choose, or simply save it, or we can save and close. We are going to save and close and see the effect on the financial statement. So we're going to say save and close, and then go back and take a look at our balance sheet and income statement. So here's our balance sheet. It's on this tab. I'm not going to run the report again. We'll go to the balance sheet. We'll make sure it's refreshed by going up and running it again, but we won't generate the whole balance sheet again. So there it is. Now let's scroll down and see what happened. Remember, although we got cash, we did not put it into the checking account because we didn't go to the bank yet, and therefore we put it into undeposited funds. So undeposited funds is stacking up with a lot of money in it. So we're going to go to this undeposited funds, and now we've got the string music. Notice within undeposited funds, there's typically going to be two types of things that increase it. The payment, that usually is what we get after we invoice, and the sales receipt, meaning we got payment at the point in time of sale. Those are the two things that will increase the undeposited funds. What's going to decrease it is when we deposit it from undeposited funds to the bank. Here's our sales receipt there. If we open that up, the 420 then is going to be the amount we got, including the sales price and the tax included, the full 420. Closing that back out, the other side of this, the main portion of the other side of this, the balancing amount to this, back to the balance sheet up top, will be on the profit and loss. If we go to the profit and loss report, just like similar to the invoice, profit and loss report, it's going to be income, revenue, called sales in our case. So we'll select the revenue, 790, and then we have our sales receipt once again. However, it's only 400 in here. The other side, once again, at undeposited funds. If we select that 400, we see our same invoice. However, we're picking up only the 400, not the 420. Why? Because that's what we earned. The rest is the government's. It's not what we earned. It's what we got taxed on, what we're required to take from the customer, not because we get to keep it, but because we have to pay it to the state in our case. So if we close this back out, we have to find that other 20 to balance out. I'm going to go back to the profit and loss here. Now that will be on the balance sheet again. So if we go back to the balance sheet to find that balancing $20, we go into the balance sheet and we're going to go to the liabilities, into sales tax payable, which QuickBooks is putting in as whoever we owe. In our case, New York Department of Taxation. That's who we pay sales tax to if we're in New York, apparently. If you're in some other state, it would be some other department. QuickBooks would be better to call it sales tax payable, but it's trying to really define what this is because it's kind of a difficult thing to track. Sales tax, it confuses things. We want to make sure that we know where it's going. So we're going to go to the 5950, and we have the sales receipt. It's broken out in two areas, but if we add them together and select that item, it would be the $20. So there's the $20 sales tax that we owe that we're going to pay. We will pay that later. That's why it's a liability. We're going to pay it to the Department of Taxation, or whatever it's called, New York Department of Taxation. So we'll scroll back up. And the next item, the next thing that we need to record is the decrease in inventory. We sold a guitar. Guitars are going to go down. The inventory up top is an asset. Here's our inventory. It's recorded in terms of dollars. That's important to note. This is recorded, of course, in dollars. We have to reduce the inventory for the one guitar we sold by the dollar amount. If we select it, then We're going to say, here's the inventory going down. There's the 320. Selecting the 320, we'll see there is our invoice. There's no 320 on this form, however. How do we know it's 320? Why isn't it on the form? Well, it's not on the form because we may give this form as a receipt to the customer and we don't want the cost on it. But we do want QuickBooks to know it. How does QuickBooks know the number then? If we close it back out, we'd have to go to the sales and we go to products and services. Sales, products, and services, we find the guitar we sold. That's where the information would be in terms of what the amount is of the cost. The other side of that, inventory going down to be in balance, is on the profit and loss report. Back to the profit and loss. Scrolling down, we see the cost of goods sold, our major expense, the biggest expense, typically if we sell inventory. We see the sales receipt. Sales receipt, there it is again, once again at the 320, the same amount that the inventory went down by, the same amount that's not on the sales receipt, but is known because it's part of the information as we entered the product into the system. Next thing we want to look at is the inventory report. If we go back to the balance sheet, we note that inventory went down. So inventory is going down, but what does that number consist of? We could go to an inventory report, kind of a sub-account, sub-ledger of the inventory. If we go back to this tab, this third tab, then we'll find it so we can keep the balance sheet and profit and loss open. Let's go to the reports on the left side. I'm going to locate this in the find field. We'll type in inventory, and we're looking for the inventory summary. So we want the inventory valuation summary report. Selecting that, we're going to scroll up top. We're going to say the date is as of, let's say, the end of the year. So we're going to say 12/31/19 and run that report. This will give us a quick snapshot of the inventory we have. So this is the type of inventory we have, the quantity, and the valuation. If we scroll down, we went to the Epiphone Semi-Hollywood. So this is it. If we select that item, we can see some detail for it. Going in there, we see that we have the sales receipt. Here's the sales receipt for string music. And if we select that 320, we'll go into the sales receipt. And of course, 320, once again, not on this receipt, but it's being driven by the item. If we then close this out and we go back, so I'm going to go back to the summary, we note that the total here, of course, 1,944 matches what's on the balance sheet. So if we go back to the balance sheet, then we see the 1,944 being broken out with that inventory detail. QuickBooks then tracking the inventory for us, giving a supporting schedule related to it. For more accounting information and accounting courses, visit our website at accountinginstruction.info.